a financial education for social justice webinar, part of a series that I started last fall as a pro bono effort trying to address racial inequity and social justice issues. And I appreciate you coming today to join me. My name is Karen Chan. I'm your presenter. And for those of you who don't know me, financial education is what I have been doing for the past 27 or maybe it's 28 years now. Initially, for the first 20 or so years with University of Illinois Extension as a consumer economics educator. And since then, on my own, still doing exactly the same type of work, programs like this. And typically delivering programs through libraries who want to provide unbiased financial information to their patrons. That is sort of my hallmark. I don't sell any financial products or services, and my goal is to provide the most unbiased financial information that I can. And to make sure that I knew my subject area as thoroughly as possible, a number of years ago, I obtained the Certified Financial Planner designation so that I could delve more into, retirement planning and estate planning and such as that. But I don't take clients. I am education only, but I do my best to stay on top of the subject area so that I can give you good, usable information. What we're covering today are several types of assistance, most of which are coming through the American Recovery Plan, some of which were just extensions of previous programs maybe established through the CARES Act last year. But we'll start out with a good deal of information about economic impact payments. It seems that there are still a number of questions out there about them. We'll also talk about tax credits, some of which have been around before, but the American Recovery Plan has made changes to them that make them even more valuable than in the past. We'll talk just a little bit about unemployment insurance, and then assistance that is available for rent, utilities, and mortgages, and then just a bit about student loans. That's probably the most straightforward part of this whole thing. And after today, I realized that let me say this. We are going to cover in the next 90 minutes a huge amount of information. And I don't think that there's any way anyone will walk away retaining all of this. So I want to kind of set an expectation. I think today is about awareness, making sure that you are aware of the various types of assistance that are out there, in general, how they work, and knowing where to go to get the details when you're working with someone where you need those details. And so everything that I cover today is posted already on my webpage at KarenChanFinancialEd.com. The second tab is COVID-19 and your finances. That's where all of this is posted. When you go to that tab, you're going to see a topic list and you can jump to that topic. I'm in the process of posting PDF files, fact sheets, if you will, on individual topics. And just so that you won't worry about this, there is a copyright on everything, but it clearly states that these can be used in financial education or counseling or mentoring situations where there is no charge to the client. And so I want you to feel pretty free with using this information. When you do go to the webpage, what you're going to see is, of course, the tabs across the top. COVID-19 is the one that you'll be looking for. You'll see a list that I've kind of truncated here of the various topics. Eventually, you will see PDF files listed for those that I have those on. Most of them will. There are just a couple of topics that have not yet been fully updated for 2021, and those are noted. And of course, that notation will go away once those have been updated. So I think the question of 2020 and perhaps 2021 is, have people received their economic impact payments, and did they get all three of them? And did they get as much money as they were fully entitled to? The good news is that it's not too late. We still have time to make sure that people do get the maximum amount that they could from these. So just a quick overview of these. We've had 3 economic impact payments. First one from the CARES Act, then the second one, which came out in December without quite as much to do, was actually in the Tax Relief Act of 2020. And then payment number 3, of course, started last month with the American Rescue Plan. The payments were all, at least initially, based on the current or most recent tax return that the IRS had in hand in order to see, was the taxpayer married? Were there dependents in the household? And if so, how old? And the economic impact payments were calculated based on that information. Now, the exceptions were, for example, people who don't file income taxes because their income is so low, but they do receive Social Security or SSI or VA benefits or something like that. In those cases, they typically received a payment based on just a single individual in the household, whereas the person could have had dependents or a spouse and been entitled to larger payments. But in this chart, I'm showing you for the CARES Act last year, payment number 1, whichever tax return the IRS had processed at the time the payment was made, that's the information, including income information, that the payment was based on. But any additional dollars that the person could qualify for will be settled up on this year's tax return that people are filing right now, the 2020 tax return. Same thing for payment number 2, except that, of course, generally people had already filed their 2019 taxes but before it was calculated. So that's what it was based on, but a chance to get any additional payment that might be deserved in 2020. For payment number 3, again, the IRS might have been looking at either 2019 or 2020 taxes if they had already been filed by the individual, and next year will be the final opportunity to get any remaining dollars that would be due on that. So filing 2020 taxes this year to claim is very important for a lot of people. And that's one of your takeaways, not just for the income impact payment, but for other things we're going to talk about. One of your takeaways today should be, it is going to be extremely important for most everyone to file their taxes for 2020 because there is a lot of money at stake. Right now, as far as economic impact payments is concerned, it'll be their chance to get any payments they didn't receive, or if their current situation entitles them to larger or more payments than what they received, they'll be able to claim that additional money. And next year, as I said, same thing, when people file their 2021 return, if based on income or family makeup, they are entitled to more than they received this spring from payment number 3, they'll be able to claim that on their 2021 tax return. And there are actually several reasons, I've already mentioned a couple of them, why people might be eligible for more when they file their next taxes. One is if they had an increase in dependents in the family, they had a baby, they adopted. Maybe their income was still a full year's 12 months good income in 2019, but in 2020, they either lost their job or saw hours reduced, their income dropped, and therefore may be entitled to a full payment where maybe they only received a partial initially. Another situation unique to payments 1 and 2 was that if there was a child in the household who was 17 or older, even if they were a dependent, the family did not receive a payment in respect of that child, but neither could the child claim on their own because they were a dependent. Some of those kids are going to have gone through a transition. They were a dependent in college over a year ago. Sometime in 2020, they have moved out on their own, gotten a job, they're supporting themselves. They can now file their own tax return as an independent person and claim payments 1 and 2 for themselves. Even someone who was a 17-year-old or an 18-year-old, still a dependent, but maybe finished high school or simply got their first job where they were making enough money where they are supporting themselves. As long as the person has become independent, they can now file that 2020 return and claim the economic impact payment for themselves. But as we'll see in a moment, on the tax return, it doesn't show up as economic impact payment. It shows up as recovery rebate credit. here's exactly what it will look like. It's line 30 on the 1040, and now everybody uses the same 1040. We don't have the 1040A and the 1040EZ like we did in the past. There is a worksheet that is used to figure out what, if any, additional money a person is owed so that they can claim it here. It's in the 1040 instructions, and it's on pages 56 and 57. The worksheet itself is on page 58. When many people look at that worksheet, they're going to get their heart in their throat and they're going to think, I can't do this. My recommendation is, first of all, if an individual is using tax software or having someone else prepare their return, then this isn't an issue. The software will walk a person through it, asking individual question by individual question, and it may be, slightly tedious, but not hard to get through. If you're doing it on paper, my suggestion is take your time, be relaxed, and don't get ahead of yourself. Just go step by step and answer the question on each line as you come to it. Don't try to anticipate where this is going. And if you just take it one line at a time, literally, you will get through this. There are concerns that people have out there about claiming the economic impact payment, or why they think maybe they shouldn't try to claim it. You don't have to have a job in order to qualify for an economic impact payment. Also, payments will not affect eligibility for any federal assistance or federal benefit programs. They're not taxable income. They're a tax credit, and tax credits are not taxable income. And someone might be worried about filing their 2020 taxes because they already got the full payment in 2019, and they think that now they may actually be eligible for less money. Not a problem. You will never, in that case, have to pay money back. If you're filing, honestly, in both cases, even if your 2020 shows that you're eligible for less money than you already received, there is no payback. The one exception to that is a single individual who is deceased and for whom a payment was received. In that case, there could be a payback. But other than that, no, once you've received the money, they're not going to come back and try to retrieve any from you. And of course, as everybody probably knows, the deadline for filing taxes this year has been extended both by state and federal to May 17th. And by the way, if anyone is getting a refund, there isn't actually any penalty for filing after May 17. There is a penalty and interest only if you owed and did not file and pay by the 17th. So what are the rules about who is eligible for these? The individual has to be a U.S. citizen or a U.S. resident alien. In married couples where one is and one is not, there are rules where they can claim a partial payment. The individuals have to have a Social Security number that is valid for employment, and they cannot be claimed as a dependent on someone else's tax return. From the tax preparers group that I follow on Facebook. Now, I don't do taxes, but I teach about taxes and I like to know what's going on in the real world. There have been a lot of people who've tried to finagle and figure out, oh, I had one of those 17-year-olds and we'll just let him file his own taxes this year and get the money. Well, the tax preparer has to ask, does he provide 50% of his own support? If not, he is still a dependent. And no, I will not file a separate tax return for her saying he's not a dependent. By the way, dependents do sometimes file separate tax returns, but they check a box that says they are a dependent. That's the key here. If someone is trying to figure out what the status is of their third payment, you can use the Get My Payment tool on the IRS webpage. Same tool that's been up there since last year, but at this point it's dealing only with the third payment, not the first two. Payment eligibility is based on the taxpayer, the spouse, and the dependents, and the dollar amounts for each of those situations has changed over the payments. As you can see, payment number 3 is worth quite a bit more money, $1,400 each for both the taxpayer and the spouse, and $1,400 for each and every dependent. Eligibility does depend on income. And I saved this here instead of putting it on the list with the citizenship and U.S. resident requirement, that list, because this is a little bit more involved and it has changed from one payment to the next. First of all, it's based on your filing status, and then your adjusted gross income for each of those filing statuses. All three payments had the same lower bar, where if you're below this number, then you should have gotten the full amount of the payments. If you're between this bar and the number in the second column, for payments 1 and 2, you generally would have been phased out by the time you got to the second number and received no economic impact payments if your adjusted gross income was above $99,000 for a single person or married filing separately, $198,000 for married filing jointly. Now, for larger families, because of the way the phase out was calculated, larger families would have actually seen a higher income number before they were fully phased out. But for payment number 3, the phase out happens very quickly. For example, here for a single person, you get the full payment until your AGI reaches 75,000, but between 75,000 and 80,000, you go from the $1,400 for yourself down to zero. The phase outs are very fast here, and similar numbers for head of household and married filing jointly. One of my goals is to not only give you information today, but to give you places to go for information. One of the things you'll notice when you go to my webpage, and to a fair extent here in the PowerPoint itself, there are links to the places where I obtain the information that I am sharing, or places where you can verify what I'm saying, or in this case, a place to go for questions. So there's a dedicated page for questions about the first payment still. There's a dedicated page from the IRS for questions about the second payment. And then for questions about the third payment, we're going to see on the next slide, but at this point, some of the main questions are about missing or additional payments that are claimed on the 2020 tax form. So they've got some FAQs on that. And then finally, that the FAQs about the current Get My Payment button, where you ask about the status of your third payment. So it takes a little poking around to find each of these pages that are dedicated to the payment that you're interested in. So that's why I've broken them out here and tried to give you direct links to the main places that you might want to go on the IRS website. Now, in addition to the economic impact payments, filing taxes could qualify your clients or your patrons for other money as well. Filing taxes this year, in my opinion, is probably the most critical tax filing season in most people's lives in terms of what it could mean to them financially. And the big reason right now is tax credits. This applies to this year, but also next year when we file 2021, because some of the things we're discussing are actually for 2021. So let's talk first about what is a tax credit. It's a dollar amount that will help you pay your income taxes dollar for dollar. So if you got $100 credit, it takes $100 off of what you owe for income taxes. Some credits are refundable, some are partially refundable, some are not refundable at all. But refundable means that, let's say you owed $100 in taxes and you have a credit for $200. A refundable credit will not only reduce your tax owed to zero, it will also get you a $100 refund for the additional amount that wasn't needed to pay your taxes. That's what a refundable credit is. And individuals who file taxes may be eligible for more than one tax credit. It's not pick one. It is, if you qualify for this one, you get to claim it. If you qualify for the other one, you get to claim it. And the first one we're going to talk about is actually, I think, the oldest of all the tax credits we're going to talk about today, the Earned Income Tax Credit, which is a refundable credit for working adults with limited income. So the criteria here are, yes, there must be earned income for this one. They must have little or no investment income. They must have a valid Social Security number, and they must have been either a U.S. citizen or resident alien for the entire year for which they're claiming. They can file taxes in any filing status except, in the last bullet, married filing separately does not qualify. So a person can file single, married filing jointly, head of household, qualifying widow, all that's fine, just not married filing separately. The income limits reflect the fact that this is aimed at lower income households. The amount of the credit is based on the number of children in the household as well as the income. So you'll see that for households with no children, the income restrictions are quite low. Families with children are able to have significantly higher income amounts and receive the earned income tax credit. And the maximum credit, again, smaller for households with no children, significantly larger for households with children. And there is no additional credit for children 4, 5, 6, 7, how many. The maximum credit is achieved with 3 children. So what's changed for 2020 and 2021? First, let me tell you how the calculation of the earned income tax credit works in general. For people with a very low income, the credit will be very low. As their income increases, the amount of the credit will increase as well, but it peaks at a certain point and then gradually drops off again as income increases. So it looks like a bell curve. What that means is that there are times when an individual could have a reduction in income and therefore a reduction in their earned income tax credit. And that could very likely have happened in numerous households during the pandemic. So this first bullet here, a special rule both for 2020 and 2021. If based on their 2019 income, if their income was higher in 2019 and that higher income would have given them a higher earned income tax credit than their real income in 2020 or 2021, they can use their 2019 income and get the larger credit. All right, something rather unique, haven't seen this done before. There are some additional changes for 2021 only, and these are adjustments for the most part about the ages of individuals who can claim the credit. In past years, an adult under the age of 26, so 25 or younger, could not claim the credit. That is going to be changed so that independent adults as young as age 19 will be able to claim the credit. Now, those rules were for childless individuals, a person who had a child themselves and was not a dependent themselves on anyone else could have filed, but these were the rules for childless individuals. Now, there is an exception for childless full-time students. So they, between the ages of 19 and 24, are still not eligible. Obviously, being full-time students, the expectation is that they're not actually independent and therefore will not be eligible. There is no upper age limit for the credit. There was in the past. There will not be for 2021. So as long as a person had earned income, that's the driving factor. So even if somebody is 70 years old, if they have earned income, and their income qualifies, then yes, they will be able to receive one of these credits. And for 2021, the credit that childless individuals can receive has been increased significantly from 500 and something for the maximum up to 1,500. And one additional change, which will be permanent starting with this year, with 2021, the rules about investment income have been made a little bit looser so that investment income up to $10,000 will be allowed. And I think the previous cutoff was around $3,000. If someone is trying to figure out whether they qualify, the IRS has what they call an interview tool on this webpage, where the person answers questions, and at the end, this assistant says you are eligible or you are not. And it's pretty straightforward and easy to use. I kind of walked through it to try it out a little bit. So I would encourage you, if you have doubts, use the assistant so that it's the IRS telling the individual yes, they are eligible or they are not. So let's leave the earned income tax credit and go on to the child tax credit. The child tax credit obviously is based on having children in the household. In 2021, now notice here, we don't really have any changes that are affecting the 2020 tax return. For the child tax credit, all of the changes are for 2021. More people are going to be eligible this year, and the credit is going to be larger. Earned income will not be required for 2021 to qualify for the child tax credit. The credit for this year will be $3,600 for each child younger than age 6, $3,000 for each child 6 to 17, and for this year, the entire credit is refundable. Usually only a portion of it is. And the income at which the credit begins to be reduced is higher than in the past. The credit begins to be reduced at $75,000 for single filers, $112,500 for head of household, $150,000 for married filing jointly. And this is the credit that you may have heard talked about, that rather than waiting until they file taxes next year to get the credit on their tax return, people will be able to opt in to getting the tax credit paid, to getting half the tax credit paid as a monthly payment to them starting this summer. When this was first announced, there was some debate about whether the IRS would be able to get set up quickly enough to do that. Haven't heard much discussion about that in the last 2 or 3 weeks. But even though there have been problems with the earned income tax credit, by and large, especially this last one, they got it rolled out when it was supposed to happen, actually a little ahead of schedule. So the hope is that they'll be able to pull this one off as well. And for those who wish to take part of their child tax credit ahead of schedule, receiving it monthly, that they will be able to do that. There are also changes for the child and dependent care credit. And again, these are 2021 changes only. In general, the amount of credit that you're able to take is double what it was for 2020. Maximum credit will be $4,000 if you have one person under care, $8,000 for 2 or more. And notice that it is child and dependent care credit. So it's not only children. If somebody's parent is a dependent of theirs, maybe the parent lives with them, and when the adult goes to work, they have to take grandma, grandpa to adult care or pay for someone to come in, that is dependent care. And so it isn't just child care that we're talking about. This credit will be fully refundable for 2021. It is reduced for taxpayers earning over $125,000, and this is a flat $125,000, not dependent on the filing status of single, what have you. One important thing to know, and we will come back to this again in a bit. If you take the child and dependent care credit, you cannot take another tax break, which is through the flexible spending accounts that we have through our employers for dependent care expenses. So I'm going to get into that later, but you can't use the same expenses for both. If you take the child and dependent care credit on your taxes, then you probably will not be using the flexible spending account through your employer and vice versa. So since taxes are so important, let's talk a little bit about how to file these taxes and where to get help. Lots of people can file their taxes for free, and not just file for free, but prepare them using software, typically software that's pretty user-friendly. You can do your own taxes using software that guides you through the process, and then when you're done, file electronically for free, which means you're going to get your refund much more quickly, especially this year, than if you file a paper return. If household income is under $72,000, they should go to the IRS webpage where they have have information about, I think it's 6 different software partners that the IRS works with. Each one has slightly different criteria about who can use their software for free, but this is the page where you can go and look at each one and say, this one I qualify for, that one I don't, so I need to use this one. Also, from myfreetaxes.com, you can use software that they provide where there is no income limit. There may be limitations to the complexity of returns that they can handle, but no limits as far as income itself. There are also places to get your taxes prepared for free. You guys are probably familiar with the VITA sites and so forth. When I looked in detail a couple of weeks ago at these, some were already full for the season. I found that some individual sites had chosen not to extend their tax preparation season beyond April 15th to be respectful of their volunteers' time. But I'm also seeing that others have extended. So it may take a little bit of looking around to see whether you can find an open slot for free tax preparation. And of course, given coronavirus, these are not typically walk in and sit down with a preparer. It's going to be more like walk in, drop off your papers, leave, get a phone call later and a package, and come pick up your package with your taxes in it. But these are the 3 places to go to look for tax preparation in the Chicago area. IRS, of course, is the operator or the force behind many of the free tax prep sites. Tax Prep Chicago, of course, focused more on just the Chicago area. My Free Taxes, available pretty much anywhere. I think it's United Way who is behind that one. Maybe some of you, as we were going along talking about the credits, maybe some of you were thinking, oh my gosh, so yeah, I'm going to help my clients, patrons, congregation, whoever it is that you're working with. I'm going to help my my group make sure that they file their 2020 taxes and get the money that's due to them. But I bet they missed some money from 2018 and 2019 because they didn't have to file, and so they didn't. Here's good news. If you are eligible for credits and expect that they would be getting a refund, you can still file and get a refund for both 2018 and 2019. The rule is that you have 3 years from the due date. So 2017, unfortunately, the deadline is passed. That was April 15th. But 2018 and 2019, you still have months in which to do 2018, and you have a year and months to do 2019, still time. Also, I'll remind you again, there is no penalty for late filing if the individual is owed a refund. There is a penalty if they owed the federal government money, but not if the federal government owed you money. And there's actually a little icing on the cake. They'll get, if they are owed a refund from these prior years, they'll get interest on those refunds as well. If someone's looking for tax preparation assistance for this year, and they also need help filing 2018 or 2019, they should ask if the site is able to help them with that. And if not, do they have a recommendation? I think, and at this point I'm operating on memory, I think it was on myfreetaxes.com where I saw that they specifically do help people with prior tax returns. I think, though, it was only on the assisted tax preparation. I don't think it was on the software, on individuals using the software and doing self-prep. But things do change, and I could be remembering that wrong, but that's the first place I would look, is My Free Taxes, if I had an individual who needed to do prior tax years. All right. This is something that applies only to employed individuals. Flexible spending accounts. They are a tool for helping working people reduce their income taxes. And the general idea is that the employee agrees to put money from their paycheck into an account for a specific type of expense, either childcare, medical expenses, or the less common one is for commuter expenses. The employee has to sign up each year. This is not something like like health insurance, where if you're not making any changes, you don't need to do anything. With flexible spending accounts, you must actively enroll each year, and you set the amount that's to be deducted from their paycheck that year. And there's generally no backing out of this. But the reason it's so valuable is because every dollar that goes into a flexible spending account not only avoids state and federal income tax, it also avoids Social Security and Medicare payroll taxes. And so the amount of overall tax that is saved can be significant even for a lower income individual, because we all pay the same rates for Social Security and Medicare tax. Well, except those individuals who have income over, what is it this year? I don't know, 135 or 140,000, and eventually they pay no more Social Security tax. The reason people hesitate to sign up for these is most people have learned the rule that if I don't use the money in my flexible spending account by the end of the year, I will lose it. And that is still generally true. There are, though, a couple of exceptions. If the employer has agreed to this, the federal law allows this, but I think the employer still has the right to offer or not these two exceptions. First one applies to both health and dependent care flexible spending accounts, and it is to give individuals a grace period into the next year as late as March 15th to use the money. The other, and it's an either or, these will not both be offered by the same employer. They would be one or the other, for health plans only, to actually let them roll over up to $550. Now, these are the standard rules. But you're going to see in a moment, we have some exceptions coming up because of the pandemic. First, the first change that is happening for 2021 for dependent flexible care expenses is that they've increased the limit that an employee can put into the account, which makes it more in line with what childcare actually costs. So instead of $2,500 to 5,250 for married filing, that should say married filing jointly. Now this year, the lowest filing, the simplest filing status would be able to contribute $5,000. Married filing jointly would be able to contribute $10,500. But again, because employers offer these plans, employers have a certain amount of flexibility, and employers, again, have the choice here whether to offer the higher contribution limits for 2021 or not. And I haven't yet seen any data about how likely or what proportion of employers are offering this. But here's the thing about the use it or lose it provision that is extremely valuable. And, every once in a while, the federal government does something that makes me sit back on my heels and say, they get it on this point. They understand the issue. What if you had put like the maximum amount into your dependent care flexible spending account last year, and you got laid off in April and you haven't been back to work since, and you've got several $1,000s sitting in this dependent care FSA? Well, for 2020 and 2021, any money that's left in these dependent care flexible spending accounts will be rolled over. It is not lost, no matter how much it is. So if there was money left at the end of 2020, it rolls over to 2021. If there's money left at the end of 21, it will be rolled over to 2022. Recognizing that last year and this year have been so unpredictable, we just couldn't anticipate correctly often what our expenses were going to be. Now, going back though to the fact that if you use the flexible spending account, it really is an either or. You either put money in your flexible spending account and use it to pay for child care, or you claim the child independent care credit on your income taxes. Either or. The one exception would be if you have expenses that exceed what you were able to pay with a flexible spending account, or your expenses exceed what you're able to use to claim the child independent care credit, then you can use that excess for the other one. So let's say you max out your flexible spending account, but your child care expenses were actually $3,000 more than that. Then just that $3,000 you could use to calculate the child independent care credit. So same expenses cannot be used both ways, no double dipping. Okay, and I'm just doing a quick check here to see whether, since I don't have a tech support person on, I've realized that I should arrange to have somebody kind of monitoring things as we go along. So I was just doing a quick look to see I didn't have anybody in chat saying that they were, couldn't hear or something like that. Looks like we're good to go. But having said that, I'm going to do one quick check again to make sure, yeah, that nobody was emailing me with problems getting in. Okay, so moving on to unemployment insurance. What happened last year in the CARES Act was that the federal government paid for expansions of the standard unemployment benefits that are done through the state. Everything is still being done through the state unemployment process, but the funding for these expansions is coming from the federal government. The names of these are very tedious. And at first I thought I would just leave them out. But then I realized that if you're trying to help someone figure out what they're eligible for, or if they're on the Illinois unemployment website and they're trying to figure out where they fit, you need to recognize the labels for these expansions. And so the first one, which applies to regular people who were already receiving or already eligible for unemployment, the federal Pandemic Unemployment Compensation Program is the one that bumped up the amount of the payments that they are getting. Right now, the weekly increased amount, it's an additional $300. You may remember that last year for several weeks, the increase was actually $600. So it's lower than it used to be. Still significant though, given that I think the average unemployment payment in Illinois is under $300 a week. And so this is a significant assistance to individuals who may have been unemployed for an extended period of time. Now, also recognizing that people are not being able to find jobs as quickly as they did in the past, then the pandemic emergency unemployment compensation comes into place. Emergency meaning we're in an emergency situation where people are being unemployed for longer periods of time. The standard 26 weeks of support is insufficient. And so this program is giving an additional up to 53 weeks of benefits after the state's 26 weeks of benefits have expired. Now, this will end, though, both of these things end on September 6th. For these additional weeks, what it means is maybe you used up your 26 weeks, but you only had 4 more weeks before September 6th came around, and so you've only used 4 of these additional 53 weeks. Then 4 weeks is what you get. The other weeks were not accessible to you. So even though you could get up to 53 additional weeks, this program is currently set to end on September 6th, and so no additional weeks at all at this point beyond September 6th. Another expansion, and this is the one that was more groundbreaking, and again, kind of recognizes that to a large extent, our economy has moved from standard employee-employer relationships to gig working and a lot of self-employed people. And so the Pandemic Unemployment Assistance Program addresses those individuals who typically would not have been eligible for unemployment at all. And so the self-employed, the independent contractor, the business owner, but also people who were employees but still weren't eligible because they were so part-time or their work history was so short that they weren't yet insured under Illinois' unemployment insurance program. Those individuals can apply under the Pandemic Unemployment Assistance Program. And it has a comparable number of weeks now, comparable to the extensions on regular unemployment benefits. But again, right now, this goes through September 6th. For claiming unemployment or getting questions about unemployment, this is the best page, I think, on Illinois' Department of Employment Security website to get started. And let me go to this page first. For 2020, Many people will find that most, if not all, of their unemployment benefits are not taxable income, even though they usually are taxed. The IRS rule is any income is taxed unless they say it isn't. And the federal law does not say that unemployment insurance is an exception. So it's often a rude awakening to individuals. They get unemployment benefits. Obviously, that means they weren't in great financial shape. Then they file their taxes the next year and discover that they owe extra taxes because of these benefits. So what they did for 2020 is most people will not owe any federal or Illinois income tax on the first $10,200 of unemployment benefits. Now, if they receive benefits beyond that, they'll owe tax on it. And if their income is above $150,000, then they'll owe tax on the full amount of their unemployment benefits from last year. Some individuals might have already filed their taxes and paid tax on this $10,200 of benefits before this law even passed on March 11th. And if that's the case, both the IRS and the state of Illinois have come out saying that individuals who filed before the law was passed, before software was updated, they will automatically be, basically they're going to make a math correction, you know, on your return, and you will get that refund without having to do anything. So don't file amended returns. IRS, I believe, expects to be making those refunds, I think, in May. Illinois has not given a time frame, but the instructions at this point are wait, that they will straighten it out. Now, let me go back to the previous slide and give you the tip for this year. If people are receiving unemployment this year, it probably, at this point, it will be taxable income. I mean, we could have another law that changes that. But right now, we have to expect that unemployment benefits paid in 2021 will be taxable. And therefore, individuals receiving unemployment should either have withholding taken from their unemployment benefits to have, like you have withholding from a paycheck, so that it's taken care of and you don't end up having a tax bill when you file taxes. The alternative is to pay estimated tax, which is a bit more of a hassle, but it's not that big of a deal. Illinois actually has a very easy system for going online and paying estimated tax. But I don't want people to be caught off guard next year and not realize that it's only for 2020 that our $10,200 of unemployment benefits is being allowed to be tax-free. That is not the usual thing. All right. Now we have a couple of ways of assisting individuals with health insurance costs right now. And I will be honest with you that this is the piece that I just am not as familiar with. It's not something I had dealt with before the recent rules were passed. And so even though I've read this and I can relay it to you, it's not something I have a real in-depth understanding of. So this may be a place where in a few days you want to go check the website, where I will have posted this information, but also the links to the sources that I'm using to learn about this. In general, the individuals who are going to get help here are people who are currently uninsured, people who have marketplace coverage but have been having to pay part of their cost, or individuals who lost their employer insurance. So for unemployed individuals or those who already have insurance through the marketplace, what's happening here is that the credits that make the marketplace healthcare insurance more affordable are larger for both 2021 and 2022. That means that the premiums are lower, might even mean no premiums for lowest income individuals. So people who have no insurance right now have an open enrollment window that goes through August 15th, that they can go and apply for insurance through the marketplace. They'll be able to see what kind of credits they are eligible for to help offset the premiums for the insurance. And someone who already has a marketplace insurance plan can also update their application. Let's say that their income has dropped. Maybe it's a married couple, maybe one person had hours cut, maybe one of them lost a job. They can update their application so that the premiums are calculated based on more current income numbers. All that can be done at healthcare.gov. So that's the help for both people who are uninsured and those who already have we would call these Obamacare insurance, additional helps for them. Now, what about people who may be uninsured because they lost their job and lost their employer health insurance because of that? You probably know that we have a thing called COBRA, which requires employers who have more than 20 employees to allow employees who leave the job to keep their insurance for up to 18 months by paying the premiums themselves. So right now, we have a special program in place that will help individuals who lost their insurance because they lost their job or their hours were cut, and their employer is required to offer COBRA. Then, as I said, spouse and dependents, as well as the employee, can keep their insurance, typically by paying the full cost. But the program that was put in place by the American Protection Plan is that the COBRA premiums can be paid for the person from April 1st and September 30th, paid in full. Now, you may be thinking, or an individual who could have taken COBRA and didn't, maybe sitting there thinking, well, I already missed the opportunity. You know, I only had 60 days after I left my employer to sign up for COBRA, and I didn't do it. Or another person might say, well, I had COBRA for a couple of months, but I couldn't afford it, so I dropped it. They have another window of opportunity here. Sometime in April or May, individuals who are still within the time frame where they would be eligible for COBRA, they should be getting a notice from their employer telling them that they can sign up at this point and premiums between now and September 30th will be paid, that there will be no charge to the former employee or spouse or dependents for this coverage from now through September 30th. So this is something where I don't know that there's much that we can do for patrons, for clients, for patients, but it's something that you should be aware of, so that if you know that somebody lost a job, and maybe they lost a job or had hours cut with a good employer where you're quite certain that health insurance was available, you might just tell them, watch out for a letter telling you that you can get your employer insurance for the next several months and have the premiums paid for you. And in case you were wondering, doesn't COBRA cover more situations than just job loss or reduced hours? Yes, but that's the only thing that's covered by the American Protection Plan to pay premiums for you. But yes, if an employee, for the second example here, if the employee reaches Medicare age and no longer takes the employer insurance, well, in this case, the spouse or dependent children could take COBRA and keep their insurance for as long as 36 months. If a spouse or dependent child loses insurance because of a divorce or a legal separation, same thing. If the employee dies, spouse and dependent child, again, have the right to keep their insurance for up to 36 months. But of course, in all these cases, we're talking about them paying the actual cost of the insurance. Technically, it's the insurance cost plus 2% in light of the little administrative tasks that have to be done to administer this. And of course, now children up to the age of 26 can still be covered under their parents' plan. When a child ages out, though, they could also continue their insurance for 36 months. So these are the full set of COBRA coverages under the standard COBRA rules. All right, so we're going to talk more about things related to the home. We're going to talk about utilities, assistance for renters and assistance for homeowners. Illinois did have a moratorium on utility disconnection, but that has ended. That ended on March 31st. What we have now is an agreement that Illinois reached with the utility companies around Illinois. The agreement was put in place on March 19th. And it's two-part, one to address avoiding disconnection, another to address a situation where they may have already been disconnected. So to avoid, and by the way, none of this is automatic. They both require positive action on the part of the renter or the homeowner. To avoid disconnection, they have to contact the utility and they must ask for a deferred payment arrangement. That's what the agreement says is to be offered to allow households to avoid disconnection. For a household that's already disconnected, to reconnect, this is about the cost of getting reconnected. First of all, for low-income customers, and I didn't really find a definition for that low-income customer, but fees for reconnecting for low-income customers are to be waived through June 20th. What that means is that if somebody is disconnected right now, they probably want to get reconnected before June 20th in case this agreement expires and nothing else is put in its place. Now, what if the disconnected individual owes money to the utility? Well, that's probably why they got disconnected. So this is probably going to be the case almost always. If the individual's income is 300% of the federal poverty level or less, they're going to be asked to pay upfront 25% of what they owe, kind of like a good faith indicator, I suppose, and the rest of the other 75% of what they owe can be set up on one of those deferred payment arrangements. So they are going to have to pay to cough up some cash for reconnection, but not as a fee. It will be going toward what they owe already to the utility company. So not ideal, but at least we have something, but it does require action on the part of the renter or the homeowner. Now, what about rental assistance? We had an eviction moratorium, and the one here in Illinois ended on April 3rd. Although the CDC says it has extended the eviction moratorium that it put in place, it seems like we're in a bit of a legal gray area. There have been a number of court challenges to the eviction order from the CDC. And so I think it's a little unclear right now whether that really is going to hold legally in any given state. So what was included in the American Protection Act, rather than dealing with eviction directly, was to provide assistance, rental assistance for renters. And so right now, perhaps as much as trying to figure out, is there a way to sign up to be eligible for the CDC's plan where presumably they'll be protected from eviction, what they may really want to do is to look for assistance with their rental payments. Now, what I have on this slide is specific to Chicago. If you go to the website, I also have links to the sources that would be providing rental assistance for suburban Cook County as well as Chicago and the statewide service. That's the difficulty with this rental assistance money. Although there's a substantial amount of dollars available, it obviously has to be funneled through local existing organizations for it to be made available to the actual renters. It takes time. It takes planning. Some are up and running, some are not. So at this point, to be honest, you'll have to go to this one and the other two sites that I will have, that I already have on the website for, as I said, suburban Cook County and for statewide, to check and see. Are they accepting applications for rental assistance? What's the deadline? Some of them may have very narrow windows where applications have to go in, and so you'll have to keep an eye on those if you have people that you want to help get rental assistance. Now, a related question are legal questions about evictions. And so I've got some links for you here on that as well. Illinois Legal Aid is always a good source for someone trying to educate themselves about what is the law about this, and trying to figure out, have they been taken advantage of? Do they have rights? And depending on the exact situation, an individual might be able to access actual legal representation through some of these sources. So, so I've got Illinois Legal Aid here for you, Illinois COVID Help, which is for housing and economic loss prevention. It's a chat bot that helps you figure out what might be available to you, and then Cook County Legal Aid, focusing on the housing issues, eviction, foreclosure, and so forth. So I hope those will be helpful as well. Moving on now to homeowners. There are three things that may help homeowners in today's economy. The first is forbearance, mortgage forbearance. A forbearance means that the payments are being paused or reduced for a certain period of time. It doesn't forgive any debt, but it gives a window of less financial pressure on a household trying to let them recover from what they may have suffered because of the pandemic. So even though it's set up because of hardship that homeowners have probably faced, notice the second bullet here. You don't have to prove hardship. And particularly, you don't have to prove that the hardship was a direct result of the coronavirus. One of the things that forbearance does for you, in addition to giving you time and space to get set up to make your payments going forward, it protects you from foreclosure while you're in the forbearance. So you don't have to worry about losing your home while you're in forbearance. And the rules for forbearance on federally backed mortgages say very clearly that the lender, because even though it's federally backed, you have a servicer that you get your bill from. That's not the actual lender. It's the administrative piece that this servicer is doing. They cannot tack on additional fees. They cannot tack on penalties. They can't even add additional interest beyond what would have accrued if you were making your regular monthly payments. So in other words, there are not supposed to be any out-of-pocket costs, and no additional costs even rolled into the mortgage because you took the forbearance. The mortgages that are eligible are all federally owned or backed mortgages, and that includes most mortgages in the United States. Now, there are some private mortgages out there. Those homeowners would have to contact their lender directly to find out what things that private lender might be offering, but they are not required to offer what the federally backed mortgages are offering right now. But Consumer Reports has a great little tool that will help an individual figure out who owns their mortgage to be sure that it is one of the federally backed mortgages and is eligible for this forbearance. And once they've done that, or they could go directly to the servicer, because that's the contact information they'll have on their monthly statements, to determine, am I eligible, and to apply for this. The forbearance, okay, forbearance is not automatic. The homeowner must request it. And the reason I emphasize this is people may get confused because student loan forbearance happened automatically without the borrower having to do anything. Not so with mortgage forbearance. You have to request it. The initial forbearance can be up to 180 days. You can then request an extension of up to 180 days. And I think there are a couple of specific federal lenders who are offering 2 additional shorter extensions of 3 months each. If after you enter forbearance, if everything straightens itself out in your life. You're back to work, you're pretty sure that it's gonna stick, you're gonna be working full time and not get laid off. You can stop the forbearance at any time. It's important to recognize that there are deadlines with some of the federal mortgages for making your initial request for forbearance. So for HUD, FHA, USDA, VA, you must have requested the forbearance by June 30th. Now, everything that I have an expiration date on in here, these could change. We've seen things get extended numerous times, but we're getting closer to the end. We don't know when things will start to get back to normal, but we can't depend right now that deadlines are going to automatically be extended. So if a homeowner is thinking about forbearance, should act on it without delay. Now, Fannie Mae and Freddie Mac currently do not have deadlines, but we never know when they might start issuing a deadline for applying. If a person does apply for forbearance, they should avoid anybody who wants money to set it up for them. There should not be any costs. And so that's a tip-off that this individual is either an out-and-out fraudster, or they are taking advantage of a situation where there shouldn't be any cost to the homeowner. Two important questions to ask. First, most of us pay our property tax and our homeowner's insurance through our mortgage payments. So if you're not making mortgage payments, you need to ask the loan servicer, so how is my property tax and how is my homeowner's insurance going to get paid? Do I need to take care of those? Make sure that those don't get lost in the shuffle here. And then ask when the forbearance ends, how do I make up the missed payments? The good news is that you will not be told that there is a balloon payment when the forbearance ends. You will not be asked to pay all of those paused payments all at once, but you may be asked to make larger payments for a period of time to make up for it. You might be allowed to simply tack those payments onto the end of your mortgage. You might be offered a loan modification where it's almost like a refinance where they recalculate everything for you and you're sort of starting fresh with a new amount of payment and a new payoff date. Depends on the exact lender. Other things that are available for homeowners, as far as foreclosures, if your mortgage is backed by a federal agency, right now, you cannot be foreclosed on by your lender or the loan servicer until after June 30. Now, again, maybe that's a movable date, but for right now, that's the deadline, June 30. But remember, if you're in forbearance, that is another way of preventing foreclosure. Homeowners could find themselves in a situation where they actually end up with some of their mortgage debt being forgiven. Debt forgiveness, the general rule is taxable income, just like unemployment benefits. But they've carved out some exceptions in that rule, and mortgage debt forgiveness is one of the main ones. Starting in the recession back 2007, 2008, and now intended to go all the way through 2025, if you have mortgage forgiveness on your main home, some people have two, mortgage debt forgiveness will not be taxable income if it qualifies as discharge of qualified personal residence indebtedness. Like I said, the main thing there is that it is your actual home where you live. What are situations where a homeowner might receive debt forgiveness? One would be if your lender agrees to a short sale, meaning that they agree for you to sell your home for less than what you owe, but the lender will not hold you responsible for the difference. They forgive that. That portion would be debt forgiveness. If your home is taken in foreclosure and it is sold for less than what you owe, that remaining amount, if forgiven, would also be debt forgiveness. And if the lender agrees to a loan modification that reduces the balance that you owe, whatever that reduction was, that's debt forgiveness. And so these are probably the most common ways that a homeowner could end up with mortgage debt forgiven. And so it's good for them to know that right now and for the next 4 years, that kind of forgiveness of debt will not be taxable income. They might still need to report it on their income taxes, but it won't be taxed. All right, last big topic here, student loan help. And I have to give kudos to studentaid.gov. Of all of the places over the past year that I have been going to get information to share with consumers about what was going on regarding everything that was done by the CARES Act or by mandate through presidential order or what have you. Studentaid.gov has consistently been up to date, thorough, totally reliable through this whole time period about being a place you could go and get accurate, timely information about what's happening with student loans. And so I encourage you, you may have questions beyond what I covered today. That's the horse's mouth. That's where you go for information about federal student loans. With federal student loans, the forbearance has been automatic, starting way back March 13th of last year by executive order, then expanded by the CARES Act, and it's then been extended a couple of times. Currently, the forbearance on student loan payments is going through at least September 30th. During this time, there is no interest accumulating. So nobody's balance is increasing because of this forbearance. So those are both already good things. This last thing, though, is like the icing on the cake. These suspended payments still work in the borrower's favor because let's say an individual is a school teacher or they're working in a nonprofit. They were working toward public service loan forgiveness of their student debts after 10 years of qualifying employment and 10 years of on-time payments. These payments that are suspended during forbearance actually count. As long as the individual is still working in an eligible job for an eligible employer and they have gotten that certified, these payments, even though not made, will still count toward their public service loan forgiveness. They will also count for individuals who are in an income-driven repayment plan. Those repayment plans are set up to be either 20 or 25 years. Some people will actually pay the debt in full by the time they get there, but others will have debt remaining at the end of the 20 or 25-year payback period, and that debt is forgiven because they have completed the repayment plan. That debt forgiveness, the 20 or 25 years to get to that debt forgiveness, these payments right now that are suspended count toward that 20 or 25-year payoff period, even though no payments are being made. And another less common situation, but important one, is people have student debts who have gone into default. They are behind enough that they're labeled in default when they go check the status on studentaid.gov. There are ways to rehabilitate or to heal or to cure a defaulted student loan. If somebody had requested to cure a default, it requires on-time payments for a certain period of time. These suspended payments during forbearance will also count toward the rehabilitation of a defaulted loan. So the bottom line here is the way this has been set up, I really don't think there's a student borrower out there who can be hurt in any way by this forbearance. I'm sure that's why the decision was made that it could be automatic, because there really is no downside. Now, which loans are eligible? Direct loans, family financial education loans, federal Perkins loans, whether they are current, whether they were in current status or whether they were in default, they were all given automatic forbearance. For HEAL loans, which are a much smaller part of our student loans, they are only in automatic forbearance if they were in default. And there are a few federal loans that weren't eligible for this. They are family federal family education loans and HEAL loans that are owned by a commercial lender rather than by the federal government. Same with Perkins. If there's a Perkins loan that's actually owned by the educational institution rather than the federal government, they were not put automatically into forbearance. How do you find out? If somebody says, well, I'm still getting bills, I'm still making payments, you want to go to studentaid.gov. I've given you the steps here to get the list of their federal loans. It will be a complete list of their federal loans. And if it's not on there, then it would not have been put in forbearance because it's not eligible. It isn't actually owned by the federal education department. So somebody might be saying, well, I could consolidate my ineligible loans and make them eligible. Well, my first thought is it's probably a little late in the game to do that, but there are some other considerations as well. A lot of student loan borrowers paid on time and in response to that received a reduction in the interest rate that they're paying. That interest rate reduction would be lost if they consolidate. Also, future payments could be higher because up to this point, any unpaid interest has been sort of pushed off to the side. It's not used to calculate future interest. It's not considered part of your balance. But when you consolidate, any unpaid interest is now rolled into and made part of your balance, which drives your interest payments going forward. If you have a Perkins loan, Perkins loans have additional protections for the borrowers beyond what even the standard federal loans do, and those special protections would be lost. You can look those up if that's an issue for you. But the biggest risk would be the biggest risk of consolidating would be for someone who is working toward public service loan forgiveness and already has payments that are counting toward that 10 years. They would lose those payments counting toward forgiveness. They would have to start over with zero and build up a whole 10 years after the consolidation. So that is a big concern. If anybody was thinking that they might qualify for public service loan forgiveness and already had employment that had been certified and counts toward that, that would be lost. A word for those who have income-driven repayment plans for their student loans. These are income-driven. The payments are calculated based on the individual's income. When a person loses a job or for other reasons has a drop in income, they don't have to wait until the regular annual recertification date where they have to report their income and their family, size of their family and that sort of thing. A person can request a recalculation at any time. And so if an individual has lost their job, seen their income dropped, they might want to go ahead and request recertification now so that when payments start up again, it'll be based on the lower income amount. Because right now, there is no recertification going on because no payments are being made. All recertification has been postponed until the end of the forbearance. And thinking about during the forbearance, the question also comes up, should I be making voluntary payments? For someone who's in an income-driven repayment plan, and if, according to studentaid.gov, you are projected to have a balance at the end of your repayment term that would be forgiven, voluntary payments would not benefit you. Unless your goal really is to not receive any debt forgiveness, or you simply want to be a more responsible person as far as paying your way. But financially, there would be no benefit to voluntarily making payments during this time if you're in an income-driven repayment plan. Now, for someone in a standard repayment plan where it's more like a car loan or a mortgage where you are going to pay every dollar you own, and the faster you pay things, the less interest you're going to pay, that's a situation where voluntary payments may make a lot of sense because Payments are being applied 100% toward the principal of a loan. Now, if there was any interest that was unpaid from way back, before March 13th of last year, that would be paid first, but anything beyond that goes 100% toward principal, which would reduce the balance and therefore reduce any interest calculated going forward. So this may be a good benefit for folks who are on standard repayment plans, so that they will be able to pay off quicker and by paying less interest. There was one other piece about student loans that was included in the American Recovery Act, and it has to do with forgiveness of student loans and the tax treatment of those. Now, let me start out by saying that public service loan forgiveness has always been tax-free. That loan forgiveness, it was already written into the public service loan forgiveness program that it would be tax-free income. But from 2021 to 2025, almost any type of student loan forgiveness will be tax-free, including private student loans that are, if they have any loan forgiveness during this time, and income-driven repayment plans. Now, income-driven repayment plans have only been around for about 20 years. And so it's only the oldest of those plans who are going to reach the end of their term between now and 2025 and have income forgiveness. So although this sounds like a big deal, it'll be a big deal for a few individuals, but it's not going to be a big deal to very many people. But nonetheless, so that you're aware, that was part of the American Recovery Plan. And I want to quickly review the permanent assistance programs that our country has in place for low-income individuals. There are links on my website for you to go to the application pages or to go for more information, but I just wanted to do a quick review of these today in case you're not familiar. LIHEAP is the program that provides low-income energy assistance. Lifeline provides assistance with paying phone bills. SNAP is what was formerly called food stamps. WIC is a special food program for women, infants, and children. As far as healthcare assistance, we have both Medicaid and all kids here in Illinois. And we have the TANF program, which stands for Temporary Assistance for Needy Families. That is actual dollar support for pregnant women and families with dependent children. All right, and very last point here. The three major credit reporting agencies actually came together and agreed to provide free credit reports weekly. And they've now extended that so it goes all the way until April of next year. You go to annualcreditreport.com, the same place you go for your free annual credit reports. This is going to let a person monitor that those mortgages and forgiveness are being reported as current the way they're supposed to be. Student loans and forbearance, same thing. Make sure they're being reported as current. And any other debt the individual did negotiations with the lender, those should be reported as current during this time period as well. And this is a tool to let you do that. All right. We have reached the end of the planned part of this presentation, so you can wipe your brow and go, whew, I got through that. I got my 1.5 hours of CE, if that was something